Welcome, Professor Diamond, and heartiest congratulations on the Nobel.
Thank you very much.
And thank you for taking time out to speak with us. The global economy is once again facing steep challenges, and experts are increasingly beginning to say that we might be looking at a recession in 2023. Now, how can banks brace for something like this? And are there lessons that they can dip into from the 2008 financial crisis?
So let me start with the second part. Because of the 2008 financial crisis, banks, independent of changes in regulation, have already pre-positioned themselves with bigger capital buffers over and above the amount they're required to hold. So that's just the bank's own behavior. You know, they have to have X% capital, and they have X plus 3% capital. So that's recent memory of a crisis gives individual institutions incentives to be a little more careful. And probably more important, the regulations have made them hold more capital, you know, which means they have less, fewer deposits and more equity. So they're a little more secured. So I would say in a lot of the world, the commercial banking sector is in a more resilient state than it was. So that will prevent a pretty small shock from bringing the system down. Obviously, a big enough shock could bring it down. So I think the banks are in better shape. Being more careful and have higher lending standards, being more transparent about what their standards are, so they tell people we're being careful. That's probably what if I was running a bank, which thankfully I don't, I like to be a professor, that would be what I would do.
We have seen a tremendous rise of fintechs in the last few years. Now, does fintechs make banks less relevant? And more generally, what kind of role and presence do you see for banks in the future?
So fintechs, there are lots of definitions of fintechs. Let me define them this way. Fintechs are institutions that do a lot of the things that banks do and did, but using a different platform and using different technology to evaluate borrowers and lenders and things like that. I would say fintechs are the shadow banks of the current time. Shadow banks are the things that do banks activities without being called banks. So I'd say it's an issue. Fintechs have got to look out for them. People have said for a long time, now that we have X, banks are toast. They're going to be done. Now that we have such low bid-ask spreads in financial markets, everybody will always finance all their stuff with equity. We won't have any banks. That was clearly when people were saying that 25, 30 years ago. Now that we have fintechs, there won't be any more banks. That's probably not true either. This fundamental thing in society that there's a profit from borrowing short-term and lending long-term, that's just there. If you make one institution unable to do that, another institution, which what Divik and I in our second paper called replacement intermediaries, now known as shadow banks or fintechs, it's just going to move elsewhere. It's sort of like whack-a-mole. You'd hit one thing down, it pops up someplace else.
Indian banking sector is dominated by public sector banks, the government-run banks. They control about 2/3 of the market share. Do you think this kind of dominance by state-run lenders are healthy, or is it time the government should privatize its own banks?
So I'm actually, unfortunately, not an expert on the Indian banking system. I can just tell you what I know about the evidence from around the world. That government banks around the world tend to do more sort of politically connected lending than fundamentals-based lending. So that could be a good thing or a bad thing. The bad thing if the political connections are through, you know, your brother-in-law or your party member, and I lend you money for a bad business, that is definitely a thing about politically connected banks. The other thing is that they could be lending to parts of the economy that need more encouragement and development. You know, so that's sort of the trade-off. The good news is that maybe because they don't have to totally maximize profits, if the government has a goal, they can allocate capital a little bit. The trouble is there's no way to leave it at a little bit. Once the government or the government official, even worse, is allocating the capital, you get this sort of crony capitalism of going to your quote brother-in-law. So that's the trade-off.
Again, in the Indian context, we are heavily dependent on weather, which plays a critical role in price movements. So what would like to know that whether do you think inflation targeting framework for the monetary policy works in countries where the external factors are so much influencing the prices.
So it's hard to think if a central bank wanted to have a goal to make sure it didn't let inflation get out of control and inflation expectations get out of control, the most natural target is actual inflation. Now, your point, I think, is a very important one, that if you have things that move prices, this is not inflation necessarily, move prices up and prices down, you can't just use today's inflation, including the goods whose prices move up and down for reasons other than general excess demand in the economy. So if you have an inflation target in such an economy, you need something that looks at that is sort of your own version of core inflation, which is like wages and the prices of these crops that don't so much move around with weather. So you need to try to look at what we call the headline inflation, includes all that stuff, and the stuff that doesn't. And you also need to look at sort of a long run moving average. You don't want to look at just today's inflation. Prices jump 10% and they're going to go down, 12% tomorrow, or if the weather gets better. That's not inflation, that's price movements. It's very hard to tell the two apart. So it's harder to have a really good target if you have these things where it's really depends on weather. Or think about, India, thankfully, is a well-diversified, very large economy. Suppose you ran a small island economy where half the output depended on one crop. Even if your weather is fine, the price of that one crop could make your inflation move all around. That would be an even worse situation. But you need to do, central banks, you need to give somebody a goal. This is even true if you have an employer-employee relationship. The employer should tell the employee what the goal is to make sure they can try to deliver. So if you want central banks to do their job, you got to give them some kind of a goal. And I think inflation targeting isn't such a bad one, even in India or anywhere.
Thank you so much. Thank you. Congratulations again. Bye-bye.
Thank you very much. Bye-bye.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.